Welcome back to the channel, guys. We have a very exciting video to get into here today. And first and foremost, before we go over the Fed meeting, the inflation report that's going to come out tomorrow at 9 a.m., 30 minutes before regular trading hours start, and the data that you guys need to know, I do want to talk about this video that I just put out at 2 o'clock. Confirmed AMC stock is about to move big. And there was a lot of negative comments on this video because people don't fully understand how the broad macroeconomics will play into AMC. And it doesn't help. Nobody teaches people about this, right? At least not in the community. So essentially, to break down how AMC is going to move big, first and foremost, when I never once said to the upside or the downside. I simply don't know. All I know is the catalyst mixed with the catalyst that we did get today is going to cause a big move. Let's break this down for people that don't fully understand. So essentially, the markets have been pricing in that the Fed is going to let their balance sheet start to run off. That is where your short-term bonds, as well as your long-term bonds, but considering the Fed's quantitative easing really started during the drop of March of 2020, those two-year bonds are going to start maturing at rapid paces in 2022 because it's been 2 years. So those bonds mature, the Fed gets paid out that interest rate. And essentially what letting your balance sheet run off means is once the Fed gets paid out, they're not going to be rebuying the same bonds over again. And that helps to drop the yield on treasury bonds. And that's what really influences your loans. That's what really is like the real interest rates. The federal funds rate, which is the raising interest rates, the scary quote that you'll hear the news talk about, that's really just the rate of which banks have to borrow between other banks to basically keep enough cash on hand to service their liabilities, right? So banks lend out money. They don't have money sitting in the vaults all the time. If they have, $300 billion of assets under management, they have to keep a certain amount of money, of liquidity somewhere in their reserves. While these banks, they're loaning out a lot of money, so sometimes they have to borrow money from other banks to make sure they are within where they need to be. Hopefully that makes some sense to you guys. The rate that these banks pay to borrow from each other is the federal funds rate. That's the rate that, scary headlines are formed from. Now, federal balance sheet runoff. That's been the main concern of investors, and for good reason, because during 2008, let me give you guys a quick lesson. Break it all down for you guys. You'll never have any questions about this ever again. And before we get into the chart, because this will all make sense in 1 second, this is the Fed balance sheet. Ever since 2008, see, their balance sheet was about $900 billion, right? $900 billion. Nothing too crazy. And then boom, 2008 hits. They start buying tons of assets. Goes to almost $2.5 trillion. Comes back down a little bit, and they're continuously buying more assets all the way until 2018 and 2019. This was the Fed Repo Crisis. I was invested in the markets. This was a very bloody time. This was because the Fed balance sheet was running off. They were not purchasing as many assets that were expiring. And take a look at the chart. Take a look at the chart. I might just blow your minds here. Take a look at the chart. Keep in mind 2018, 2019. Scroll this baby all the way out. So we know what happened 2008. The markets dropped dramatically. The, almost crashed the financial system. Don't even need to be explained. Fed was buying assets all throughout this time. Stock market was doing great, plenty of liquidity. Markets started to rally again all the way until 2018 and 2019 when the Fed started to essentially get rid of their assets. Then you've seen a major correction in the markets at the end of 2018. About December 21st was that low. The day before Christmas was really bloody. So that's the situation, and that's what markets are really fearing, is a major correction due to the Fed starting to get rid of their assets at even potentially a faster pace than 2018 and 2019. And considering the Fed balance sheet now is at $8.8 trillion, they're going to have to do this. So this is inevitable, but the longer it takes, the more time we have to be bullish and to make gains and see stocks go through big rallies. So this inflation report is going to force the Fed's hand tomorrow to act more quickly if inflation is over the estimated 7%. So in that case, you'd see the market selling off quite dramatically. If the inflation number comes in for the first time less than the previous time, in a substantial way, because the last report was about 6.8%, 6.9%. If the inflation reading comes in at, say, 6%, which I think is pretty reasonable, 6 to 6.5%, that'll be a downtick. And that will mean the Fed won't have to act so dramatically to get rid of their assets, to dump them on the marketplace, and you will see a major rally because of that. I don't know if AMC will move up a lot or down a lot based off of this, but I know the facts and I know the macro trends. And here's the history lesson, the macroeconomic lesson of what happened during the Fed Repo Crisis and why tomorrow is such an important CPI number as well as what Fed Jerome Powell said today. So sorry to bore you guys with that, but I had to put that out there because nobody teaches you guys about this. And I hope a lot of people see this video, because you wouldn't be as confused or call me clickbait for this title if you knew the data behind it. So let me know if that makes some sense to you guys. I will make a whole video breaking this down step by step if you guys want, just because it's something you need to know throughout, your investment lifetime, but while you're in this trade with AMC. So just let me know down below in the comment section if you guys understood that or if you want a further in-depth video about that. As far as where AMC looks right now, we did hit that low, like I've said many times, at $20.80 per share, and we did see about a $12 move from this low December 14th all the way to this high on December 21st, about a $12 move. So it wouldn't surprise me if the inflation readings come out at about 6 to 6.5%, and you see the markets react bullishly to that because inflation is starting to go down. And we could see a big move, $24 would be reasonable. That's about a 7-8% move, or even $26. That's about a 15% move if my rough math is correct here. So that could be very bullish, and that could more than likely happen, but we could also fall back down to the $20 range, or even slightly under that if the inflation reading comes in over 7%. I personally don't think it is going to, and if I were to gamble on the stock going up or down tomorrow based off of inflation, I would gamble that the stock is going to go up. Not saying you guys should do that, but that's what I would do if I had to put my money on the line. As far as the Ortex data, we're looking at 18.03% short interest of free float, 92.58 million shares that are sold short, with a share utilization of 76.59% and days to cover at 2.48 days to cover. So nothing has really changed here. Still looking for that correlation when the stock goes up and the days to cover will go down. This right here looks very, very good. You want to see days to cover as high as possible because that's telling you it's very hard for shorts to get out of their short positions if they wanted to in a rapid pace. The days to cover is literally how long it would take to cover 3 million shares out on loan. So keep that in mind. As far as the stock tracker data, you guys could see that we only have about 8,500 calls that are in the money for this Friday and about 99,000 calls that are out of the money for Friday. So if we do see a big bounce for whatever reason, you're going to see a lot of calls go into the money. You could see a short-term gamma squeeze like event. As far as the put side, about 24,000 puts that are in the money and about 58,000 puts that are out of the money. But that big week is going to be next week, and there's not going to be too much going on besides earnings next week. And if earnings are good, then we should see a very bullish reaction as well, or a continued bullish reaction, considering if inflation is good and the markets rally tomorrow for next week. So keep that in mind. We're still looking at a big possible rally for this January 21st expiration date. Now, as far as the max pain, we could see that it's about $23 per share for this Friday. So that would still signal some upside from where we are currently at. But I do think it's possible we could be substantially higher than $23 by Friday. Could be wrong. Might be wrong, might be right. Doesn't really matter. We're in this for the long-term trade anyways. So that's basically all I can give you guys, and that's what you guys need to know. If you found value out of this video, hopefully you learned something. Hit that like button for me. Consider subscribing to the channel as well. Love and appreciate you guys. Thank you for watching. I will see you in the next one.